What we could be seeing is the beginning of a divorce between the Nasdaq and Bitcoin. We're heading to 3,100 on gold in the next week or two, looking at 150 Bitcoin by the end of the year.
You rightly called at the end of last year that this was probably going to be what they were going to do out of the gate to reset things.
They're trying to thread the needle and save us from a complete financial collapse. There's going to be ways that they are literally going to strip away power from the Federal Reserve. The era of central banking dominance is coming to an end.
And Jason Calacanis was tweeting about this. I was quote tweeting him last night about this idea that to fix the housing crisis, we just need to build 1 million affordable homes to bring the prices down, flood the market with more supply. And I was saying, commenting that the problem, I don't think, can be fixed by some sort of central planning of expansion of supply by 1 million homes. The problem is that people are using real estate as a store of value asset when it really should be a consumption good with some premiums that can exist due to location, size, aesthetic, whatever it may be.
Yeah, no, I think that's definitely the case. I think homes in the S&P 500 are essentially Ponzi's. If you really break it down, like it's like, okay, if someone's going to pay more for it's not based on the traditional valuation metrics anymore. And this is a big problem I have when I listen to, people on like CNBC, and it's like, oh, well, they're always like trying to justify like some sort of rational valuation metric. And then the market shifts and then they're like just changing their whole call. Like, oh, well, NVIDIA's got this growth earnings, and so therefore this is a very fair valuation. And then NVIDIA goes down 30%. It's like, well, we knew that their growth was going to have to slow down at some point. So they're always like retrofitting the valuation. And I think the reason they're doing that is because it's not really based on that anymore. That when the stock market was the kind of place for elites to invest money, and they looked at it and they did DCFs, and a lot of times they actually did discounted dividend models. So a lot of times they literally looked at it like, what is a fair multiple of dividends, like for the cash flow? And at a certain point, between passive investing and between 401k and the massive shift between defined benefit plans as the pension system in the United States to defined contribution plans and 401k, it simply became like a financial mechanism to basically shift wealth into, the older generations based on what younger people would contribute. And it started to really divorce from valuation fundamentals, and housing did the same thing, which is, I think, what you're saying. They became substitute store of value assets because there wasn't a really good store of value asset. And obviously, as you and I know, Bitcoin is designed to be the perfect store of value asset. And that's what's slowly taking place as people starting to realize that.
Yeah, as I was telling you, I was in DC last week for the Bitcoin Policy Institute event, catered around content, sort of putting forth the idea of this strategic Bitcoin reserve. And I was highly encouraged by the amount of senators and representatives that were in the room seriously digesting the content and taking our perspective seriously. It seems like things have definitely shifted with the second Trump administration, which is why we're catching up, because the last time we caught up was right before the new year, and you had laid out your ideas for what was going to happen, particularly the effects of the incoming Trump administration on the markets. And so far, what you predicted or what you said would happen when Trump got into office has played out almost perfectly in terms of markets crashing, a quick crash, a reset with these tariff policies and other economic policies. And people are running around like the hair's on fire. But I think if you take a step back and you just approach this analytically and objectively, many people are saying that Trump has no idea what he's doing and pointing at the markets as evidence of that. But I think you rightly called at the end of last year that this was probably going to be what they were going to do out of the gate to reset things.
Yeah, I mean, I'm getting more bullish every day. I mean, it's like I looked at it back then, and I thought like there's a lot of stuff being priced in that like is not taking into effect what I would call reality. And it's like, it's like, okay, we're going to, decrease inflation to 2%. We're going to make housing affordable. We're going to pump up the stock market. We're going to get manufacturing back here. Like the list could go on of what was promised. And it's like, there's no magic wand that can just be waved and this happens. The only potential way this happens is through a series of events. And that part of that series was going to have to be a interlude of uncertainty of, is this really going to work? Is it really going to produce the growth at the end of the light at the end of the tunnel? And that during that period of uncertainty, I was like, there's definitely going to be, a sell-off. And I basically said in December, I'm like a 10 to 30% sell-off. And that was a wide range. But if you had to do a point estimate on it, it would have been a 20% sell-off. And I still think that could be about right, which would give us another, from the lows of the S&P, which were around 5,500, could be another, 10%. On Bitcoin, I had looked a lot at monthly charts. And I wrote down some numbers like the monthly close high in 2021 was 61K more or less. The monthly close low in 2022 was roughly 16K, and that's a 44K spread. And if you add that 44 to the previous high of 61, you get 106. And that had been my initial target, was around a 106 range. And I think we got to like 108 or something like that. And I said, typical thing to happen when you get a move like that is you retrace 50% of it. And the 50% retracement was $83,774 on a monthly basis. And we literally last month in February closed like within $100 of it. We closed Feb at like 83. I don't know. It was something within $100 or $200 of a 50% retracement of those monthly highs. And my point was that would be a normal retracement on a monthly level. Intermonth, we'll see what we're going to see. And then I think we ramp back up. And what we do is we do another 44K on top of that 106K. And that's going to get us to 150. And that's my 2025 year-end target. I think we could do more than that, but I still think we're looking at 150 Bitcoin by the end of the year.
It's a nice humble pump. Many people are calling it. I'm not sure if you saw this Josh Mendel character pop out of nowhere. He made the 84,000 on March 14th call. And he was within a couple $100. He's calling for 444,000, but I think whether it's 440, that would be incredible. 150, just going up would be good, because I think it would validate the long-term thesis that Bitcoin is something that's here to stay, that people should own, and marching towards 150 is a validation of that thesis, I think.
Yeah, and I think what is possibly going to happen, and I can't guarantee it obviously, but I think what we could be seeing is the beginning of a divorce between the Nasdaq and Bitcoin. And I think that's a very important thing to happen. And for it to begin to break down that strong historical correlation with risk on. And I think, there could be fundamental drivers for it. So we could see, for example, the Nasdaq go down lower, and then we could see some positive announcements of, say, states or, some sovereign in the Middle East saying we're going to put in a Bitcoin reserve. And all of a sudden the market needs to say, okay, Bitcoin is not the Nasdaq. I think this is a huge maturity point for Bitcoin. I predicted it in I put out a post at the end of 24, like top 10 predictions for 2025. And one of them was that during this year, Bitcoin's going to break its super hyper strong correlation with the Nasdaq. And I think if it can do that, like that's going to be huge, and that's going to be a big thing for Bitcoin. And I I think it hasn't done it yet. And, we will see what happens. But, like I said, a lot of the things I predict, they don't happen next week. They take a few months to play out. But hopefully by the summer or the fall, we'll start seeing that Bitcoin is not trading, as a high beta, Nasdaq play.
What's up, freaks? Do you have a credit card? Are you getting cash back or airline points or points for some other service? Guess what? Those are shit coins. You want to be stacking Bitcoin. And I have some groundbreaking news for you. The team at Fold has finally released the Bitcoin Rewards credit card. They have a wait list. They're going to be distributing the cards later this year. So you want to get on the wait list. Fold Plus members are going to get unlimited 2% Bitcoin back on this credit card. If you get on the wait list, they're up to $200,000 in prizes they're going to be giving out. So get on it as quickly as possible. Go to tftc.io/fold and get on the wait list there. If you're on the wait list, you have the potential to win some of the prizes. Check it out. Sup, freaks? This rip of TFTC was brought to you by our good friends at Bitkey. Bitkey makes Bitcoin easy to use and hard to lose. It is a hardware wallet that natively embeds into a 2 or 3 multi-sig. You have one key on the hardware wallet, one key on your mobile device, and Block stores a key in the cloud for you. This is an incredible hardware device for your friends and family, or maybe yourself, who have Bitcoin on exchanges and have for a long time, but haven't taken the step to self-custody because they're worried about the complications of setting up a private public key pair, securing that seed phrase, setting up a PIN, setting up a passphrase. Again, Bitkey makes it easy to use, hard to lose. It's the easiest 0 to 1 step, your first step to self-custody. If you have friends and family on the exchanges who haven't moved it off, tell them to pick up a Bitkey. Go to bitkey.world, use the key TFTC20 at checkout for 20% off your order. That's bitkey.world, code TFTC20. During our last conversation, I want to dig into the policy out of the gate with this Trump admin. During our last conversation, a lot of the focus was on Treasury Bessent and comments he's made in the 12 to 18 months leading up to the 2024 election. Obviously, we talked about Doge and tariffs and the effects that'll have on the policy. And then I'm not sure, or on the economy, excuse me. I'm not sure if you caught this yesterday, but Treasury Secretary Bessent was on Meet the Press, and he had this one line that signaled to me that essentially confirming the core to your thesis. I know it's coming. Yeah, I mean,
let them eat flat screens.
Let them eat flat screens. The American economy is not let them eat flat screens, and I thought that that line was incredible, not only for how eloquently, or not even eloquently, how simply it described what the American dream should be. It's not about being able to go out and buy a 80-inch flat screen for $300. It's about being able to pull yourself up from your bootstraps and honestly and earnestly believe that you have the ability to go out there and make something of yourself and climb the economic ladder. And I think that line signals where this administration is thinking from a policy perspective, which is the stock market is not the economy. We really need to reinvigorate the middle class and bring true wealth and productivity back to the American economy.
Yeah. I mean, when we talked last time and I was like, okay, the market's probably going to go down and it's not going to look pretty for a while. And I said, look, they're going to come out there with messaging, they're going to blame the Democrats. They're going to blame, ridiculously high deficit to GDP spending. They're going to, and in many ways, they're going to be right. And what they're trying to do, in my opinion, is they're trying to thread the needle and save us from a complete financial collapse. That if we had continued on the path, let's just you go into a weird universe where Kamala Harris won, and they just said, okay, let's just keep doing what we're doing. Let's keep doing 7-8% deficit to GDP. Let's keep doing government spending up the wazoo. Let's let U.S. debt go from 36 trillion to 45 trillion in the next 5 or 6 years. And at the same time, the economy is going to be growing, which is going to do what? It's going to push up the 10-year yield. It's going to put up interest rates, which is going to do what to our net interest expense? It's going to, balloon out of control. And we're essentially going to head for another Great Depression. Like, I really felt And I still feel like if we just would continue on that path, that is what was our destiny. And I think what they're trying to do, and I don't know if they will be successful. I want to be clear. I think what they're doing is a thread the needle strategy that has a lot of moving parts to it, that, things could, go off the rails. But if they're successful, I think what they're trying to do is they're trying to realign us to a path of sustainability. And it's going to have hot parts of it and cold parts of it. I call it a salsa and sour cream strategy, where, if you look at salsa and sour cream, they're usually paired together because there's something called like capsaicin or something within sour cream that dulls the salsa. And so they've got different things where they're like, okay, we're going to fuel the economy by forcing, longer rates down. That's going to drive down mortgage costs. Eventually, and this is a huge part of it, is housing. I think that's going to unlock, people doing second mortgages. And there's over $13 trillion of equity that Americans have in houses that can be unleashed. So I think they've got all these salsa components, but right now we're getting a big dollop of sour cream. We're getting tariffs. We're getting decreases in government spending, which has been juicing the economy for many years. So we're getting a lot of cooling components now. I think the salsa components are waiting in the wings, and they're doing it in the right order, which is first you had to cool things down, bring down interest rates, bring down oil, and then you start to unleash all of these, like, what are in essence inflationary components, because what you're doing right now is you're putting in deflationary components. I think actually tariffs are deflationary. I don't think they're inflationary at all. And so they're introducing deflationary components right now. We've also got a massive secular deflationary component, which is AI. So we've got all these deflationary components that we're facing right now. I think that's what the stock market is reading. That's what's driving down 10-year yields. And then what they're going to do is then all of a sudden in the summer and the fall, I think unleash the salsa and the hot components that are just going to fuel this back to 7,000. So that was my prediction. It was like, we're going to come in, we're going to have a 10 to 30% correction. It's going to be V-like, and we're going to rebound quickly, and we're going to end the year closer to 7,000 on the S&P, 150,000 on Bitcoin, 4,000 on gold, and be set up for basically one of the best economic times we've been set up for. But there's going to be a period, and it's going to be substantial, and it's not going to be fun in the first half of the year, where we go down and people get scared because they don't believe in it. And eventually they will believe in it, but I still don't think they believe in it yet. And that's why I think we've probably got further down to go. But we are setting up for a little bit of a bounce here. But I think if we get to a certain point, I'd probably be ready to sell that bounce. But I think we'll probably bottom sometime in May or June, not in March.
How would you grade the execution of this salsa and sour cream policy so far?
It could be better, but I totally see their point. So like some people are like, oh, Trump is being too harsh, and he's like, this is the way I guess I could analogize it. Let's just say you've got one car to sell. You're a car salesman. And if you sell this car, you hit your monthly bogey. So you need the unit sale. But you also want the commission. And let's say you get a commission if you sell that car over $30,000 and you're dealing with a potential buyer. Well, you're going to want to try to sell it for $35,000 or $40,000 and hit your commission. But what really matters to you is hitting that unit sale, so you hit your unit goal and collect whatever that bonus might be. And then on the other end, you got a buyer who really needs the car. But on the same time, he wants to save money. And so if you go into that negotiation and the guy who needs the car is like, oh, I really, really, really need this car, I'll do anything for it, you're being stupid. And the same thing with the salesman. If he's like, oh, I just need to get this sale, I don't even care if I make a commission on it, I just need the sale. And that's Europe, or that's China. And then Trump on the other end is kind of the car buyer, if you will, of these products. And so they're both coming in with a bunch of rhetoric that is not anywhere near how they truly feel on the issue. And so at the end of the day, Europe really needs the sale. They need the units. Like they can't just give up the American market. Their economies will collapse. On the other hand, Trump, as the car buyer, and I said this car buyer, hypothetical car buyer, really needs the car. Like he doesn't want to give up the European market either. So they're both just jawboning. They're talking their game. And this is the thing that always happens with Trump is like Marco Rubio, little Marco, and they're playing their hands. And now he's his right-hand man in the Secretary of State. It's not like, a normal guy in the street where you walk up to the guy in the street and you say something mean and nasty to him and he doesn't want to have anything to do with you. These people are playing, hardball. They're playing big stakes, and they're not going to let comments or ruffled feathers get in the way of the deal that's ultimately in their best interest. And so right now you've got everybody playing hardball, whether it's Canada, Mexico, Europe. They're all talking their game. Trump's playing his hardball. He's all talking. And I knew this was going to come. That's what I said was basically going to be the cause of the sell-off, is that for him to get what he wants into place, there's just going to have to be this period where people are basically at each other's throats. And at the end of the day, though, these people, I think, can be counted on to do more or less what's in their interests. And then there are things that are differing interests. I think, for example, Europe has a different interest vis-a-vis Ukraine than America does. So I think, like tariffs is one thing where like ultimately we want to keep a trading alliance together. I think on the other hand, there are certain reasons why Europe is more concerned with Russia than the United States is. And so there are areas where we overlap and we're going to eventually come together. I'm pretty confident about that. And then there are other areas where we might diverge, and those things will play out how they play out. But as far as the economy is concerned, I think nobody wants to go back to, not having the American markets open to them. And ultimately, some sort of solutions will be found out. And once those get found out, once they get resolved, once the rules of the road become clear, and then the salsa starts getting added on, which I think is things like expanding second home mortgages, government guaranteed, which I think could be a sovereign wealth fund with Bitcoin, with gold, that is then used to kind of leverage up the U.S. balance sheet. Once those things get going, and the deregulation, lower oil prices, once those things then get into place, then the market's going to take a step back and say, whoa, we misread this whole thing. Trump was a master. He played it wonderfully. And I'm not a Trump sicko fan. I don't think he's a perfect guy. And I disagree with him on some issues. I think he's too strong in favor of Israel, for example. But I do think that eventually this is going to play out in a good way for the U.S. economy and for the U.S. stock market and Bitcoin and gold.
This rip was brought to you by our great friends at Unchained. As Bitcoin's role in the global financial landscape evolves, understanding its potential impact on your wealth becomes increasingly crucial. Whether we see measured adoption or accelerated hyper-Bitcoinization, being prepared for various scenarios can make the difference between merely participating and truly optimizing your position. This is important, freaks. This is why Unchained developed the Bitcoin Calculator, a sophisticated modeling tool that helps you visualize and prepare for multiple Bitcoin futures. Beyond traditional retirement planning, it offers deep insights into how different adoption scenarios could transform your wealth trajectory. What sets this tool apart is the integration with the Unchained IRA, the only solution that combines the tax advantages of a retirement account with the security of self-custody. In any future state, maintaining direct control of your keys remains fundamental to your Bitcoin strategy. Go explore the potential futures at unchained.com/TFTC. Bitcoin is going up. Make sure you're protecting it the right way. Make sure you have a good partner. That is Unchained. Go to unchained.com/TFTC. What are the external factors and variables that could throw a wrench in all this, do you think? Is it something like Ukraine, Israel, whatever it may be?
I think Israel is a big one. Yeah, I think Israel is a big one. Because, there's a guy, a well-known professor from University of Chicago, John Mearsheimer. He wrote a book called The Israel Lobby, and he's basically spelled out how there's a weird situation between the United States and Israel, which is there's just a very, very powerful lobby of United States citizens who also happen to be Jewish and perhaps even Israeli citizens, dual citizens, that are very powerful and that contribute a lot to political campaigns for congressmen, for senators. And so sometimes the U.S. winds up doing things that are not in the United States' interest, but are in the interest of Israel. And in this, we've seen this escalation over the weekend with the Houthis. And it seems relatively clear that Netanyahu wants to try to take out Iran, possibly just to take out their weapons capability, but he could have broader aspirations. He was in charge, I believe, back in 2003, 2004, when we were in Iraq, and he wanted us to continue after Iraq to go into Syria and different things. Like in Israel is in Syria now. So Israel's in Syria. They've got positions in Lebanon. Like that, this whole Israel thing is probably the biggest wild card in the whole mix, and it's also something that I think is complicated by the fact that there is a very strong lobby on behalf of the state of Israel in the United States, something that, for example, Ukraine doesn't have.
Yeah. And I think if the history of the 21st century has taught us anything, it's that meddling in Middle East affairs doesn't always work in our best interests and is never as easy as it may seem at the onset. I mean, Syria is a perfect example. I think Tulsi Gabbard did an incredible job of sort of predicting exactly what would happen there if we let the rebel forces take out Assad, and lo and behold, within a few months, Syria is a complete shit show with ISIS taking over and slaughtering religious minorities, particularly Christians. And I completely agree. I think I could see catering to the whims of Israel's wants in that part of the world could distract us from what we're trying to do at home, which I think is extremely admirable, worthwhile, and where our focus should be. It's just resetting the American economy to make sure that we don't live in a world where let them eat flat screens is the economic policy here domestically.
Yeah, exactly. And I mean, if you look at, I mentioned something earlier, like just Europe's interests might slightly diverge. I think from the U.S., I think it's easy to think, that Europeans are being silly with wanting to support Ukraine. But I think if you look at European history over the centuries, Western Europe has always wanted the resources of Russia. They've always wanted it. Germany did. Even if you go back further, Britain, France, I mean, they looked at the resources that Russia possesses, and then they had this, kind of Western European superiority complex where they just looked down upon Russia and the Slavic peoples. And they've constantly wanted that. And I think when you look at, like, for example, Germany, and you see that Germany was brought to their knees a little bit by this Ukraine issue, given their dependence upon Russia for oil and natural gas, I think there's almost a legitimate, like national interest in some of these Western European states to say, we want to be able to control Russia because they are our primary source of oil. And this is not too dissimilar to 1970s, 1980s, when the United States was at its largest point of being a net importer of energy. And we were brought to heel by Saudi Arabia and OPEC doing, price controls and boycotts on sending oil to the U.S. And we had the famous oil lines in the United States, and only odd number license plates could get oil on this day. And the United States came out and basically said, like, this cannot go on. And there are recently declassified documents from like Kissinger under Nixon, where they were drawing up plans to invade Saudi Arabia, because the point was like, we cannot be held hostage for oil or energy by the Middle East. And I think in some sense, Western Europe has felt, oh my gosh, we're being held hostage by Russia. And so they have this almost legitimate, I don't want to like give a blessing to it, but it's an almost a legitimate national interest of like, we can't let Russia be so independent with their huge nuclear arsenal. And if we can weaken them in any way, that's a real big benefit to us. But that completely diverges from the United States interest, which is if we really, become aggressive against Russia, we drive them more into the arms of China. And if Russia and China are together, and then also Russia's been developing a lot of strong allegiances with India because India needs Russian oil, that puts us in a negative spot. And so I think there's a legitimate, this could be like a second concern. So number one, there's a divergence between U.S. interests and Israeli interests. And then two, there's a divergence between U.S. interests and Western European interests. And so what the United States is really, I think, needs to do is extricate itself a little bit from being a protective uncle to Europe. And I think Trump's willing to do that. I think he also needs to do that to Israel, but I think that's more difficult to do because of the strong lobbying controls and positions that are there with Israel.
I completely agree. I think as it pertains to Western Europe specifically, I think it's easier to sort of cut ties and say, hey, we're not the protective uncle anymore because of what's happening socially and politically over there in terms of their aversion, it seems these days, to Western liberal values of freedom of speech and secure borders, which weren't values here until recently. But I think it's much easier from the Western Europe perspective to be like, hey, you guys are going a little nuts right now. Well, we need to get things in order at home to make sure that we're on stable footing. And so if you guys want to go about this, you're going to have to go it alone. And I think the argument is made significantly stronger when you consider the amount of money that's been sent that way for the war in Ukraine over the last 3 years. So when it comes to Israel, they do have a lobbying stronghold, and obviously it is a hyper vitriolic topic that brings about a lot of blowback if you try to approach it. But I think if you just state politic it and just don't bring religion or ethnicity into it and just label it as state actors interacting with each other, it's like, hey, I don't want to get dragged into more Middle Eastern wars. It hasn't worked out for us. It's not in our best interest. We have a lot to fix.
And there's no reason to, because there's actually a propensity for a number of powerful Middle Eastern states to strongly ally themselves with the United States. So, countries like Saudi Arabia, which feel threatened by Iran, are really like itching to just, solidify partnerships with the United States and actually even with Israel. And it's just not a good situation. And so these are the big things that I think are worries on the market. They're the things that could get in the way. But I think at the end of the day, these will be navigated through. I think they've always been navigated through. And I think really when you look at things like tariffs, I think they're really being thrown out there as like a reason for the market to sell off or what have you. I don't think it really is about tariffs. I think what Trump is trying to do with, reinstituting manufacturing in the U.S. is a complete realigning of the global monetary order, the post 1971 monetary order, where the United States prints treasuries, people sell their goods cheaply into the United States, the U.S. exports treasuries, those treasuries float around the world as currency for the world. I think that system is breaking down, and that's one of the reasons why you're seeing things like the German stock market do well this year is because people like China, which have historically sold in the United States, taken those dollars, and yes, some of those dollars they bought U.S. Treasuries, but a lot of those dollars got sent into U.S. real estate and also the U.S. stock market, and saying, okay, maybe we're not going to sell as much into the United States anymore. Therefore, we can't buy as much U.S. assets anymore. Therefore, let's buy European assets. And this is one of the fundamental drivers of the break between Bitcoin and Nasdaq. Is Bitcoin is not a U.S. asset, right? Now, China does have restrictions on Bitcoin. However, their citizens and given the nature of Bitcoin are still able to own it. And they're doing that in large numbers. They're also buying gold, another neutral asset. And so this break from, for example, the Chinese buying the Nasdaq, buying NVIDIA, is part of what's going on here. And I don't think it's necessarily because of tariffs. I think it's more of a broader change in the monetary order, which has simply been U.S. print more treasuries, increase our national debt, supply the world with dollars, dollar sends cheap goods. Once the BRICS nations basically said, we don't want to play that game anymore, then I think the United States, especially I think Bessent understands this, like that is no longer a sustainable path for the next, let's say, 5 to 10 years. It might have been sustainable for another 2 or 3 years, but eventually it was going to hit a roadblock and it wasn't going to work anymore. And so we're getting this complete reordering. And in this intermediate period where people are like, okay, the traditional buyers of NASDAQ, US real estate, Bitcoin, they're now buying other assets. That causes a dislocation, that causes, a price drop. But what will happen is that people will then begin to realize, okay, for every one of those buyers, there's going to be another new buyer, which is, okay, United States citizens, for example, are going to have higher real wages. They're going to be a larger manufacturing group, which is going to cause reinvestment. So instead of foreign direct investment from China buying U.S. real estate, it's going to be companies wanting to put up data centers, or it's going to be, like I said, a rejiggering of the Fannie Mae Freddie Mac system that unleashes second mortgages that lead to Home Depot and Lowe's stock going up, and then there's going to be certain probably incentives for first-time home buyers. I think they're going to be putting in certain things like government cap mortgages, like things that we just really have not seen. These are things that are outside of the Overton window, things that we thought we wouldn't see, and that if they were done, let's say in January, would have just caused inflation and the stock market to spike so high, it would have led to a collapse. But once we cool things off a little bit, once we do that sour cream, then they're going to come in with the salsa ideas. And they're going to be things like, okay, guess what? We're doing a government-backed Fannie and Freddie home loan for first-time home buyers that is capped at 3.5%. And, these are things that are not outside of the realm of possibility under a Trump administration, and that can just totally stoke this demand and start driving this internal virtuous circle of demand that's going to replace this external virtuous circle of demand that has existed for decades. So we're essentially transferring the entire flow of capital from Plan A, which was, again, U.S. print dollars, go out, dollars come back, recycled back into the U.S. to buy U.S. assets, to dollars are going to begin to be printed within the United States for recirculation within the United States. And I think there will be some inflationary impacts to that. And that's what I think is also going to be beneficial for gold, Bitcoin, and the stock market. But it's not going to begin to occur until probably the summer or fall of this year. And once people start to see, okay, this is what's going on, then I think there's going to be a mad rush, and we're going to have a ridiculous, climb, and that's how I can easily get to my 150 Bitcoin by end of the year target.
How does the Fed play into this? Do they need to play ball, particularly for that mortgage idea? It seems like rates would have to be lower, the Fed funds rate at least, to justify it.
Yeah, I think part of the Trump administration is to neuter the Fed. It's to take the Federal Reserve out of the picture. That the Federal Reserve is an anachronism. It is a holdover from the days of the gold standard. The Federal Reserve existed in 1913 because there was a point where the government needed gold to back its currency. And the only way you could get gold is you go to rich people. And the only way you could access those rich people was to go through banks. And so the Federal Reserve was created as a go-between between the wealthy and the government. And this is the initial creation of the Bank of England, 1694, William III. He had basically borrowed money from wealthy people. He could not pay it back. He was involved in a war with France. And he went to these wealthy people and said, I need to borrow more money because I'm involved with the war with France. And the wealthy people said, we're not going to lend you any money, King William, because you're not good for it. But what we will do is if you give us a charter, and this was the charter of the Bank of England in 1694, if you give us a charter to print paper money, we will collect paper money or collect gold and silver from the population, take it into the Bank of England, issue them paper notes, give you that gold and silver at interest. So basically what it was take money from the people at no interest and then loan it to the sovereign at interest. That is the basis of a central bank. This is the basis of a central bank from the beginning of time. It is to fund the government through the people's money while bankers and rich people collect interest rates. And it was necessary because money had been based on gold. Once we left the gold standard, and this has not completely sunk into people yet, is that there's no need for a Federal Reserve. And the United States could issue United States notes. They could do whatever they want. And I think when Bessent talks about, he says, reprivatization of the economy. And when they talk about we're going to utilize the asset side of the balance sheet of the United States, I think these are comments that are hinting at the taking away of power from the Federal Reserve. So what they're going to do is they're going to bring monetary policy into the United States Department of the Treasury. And let's say, for example, they set up a sovereign wealth fund and Bitcoin is in it, gold is in it, cash flows from oil and lease contracts are in it. Maybe they might take some of their massive real estate holdings and start selling those off to private companies, renting them out to federal agencies, and then those federal agencies pay rent and comes into the sovereign wealth fund for cash flow. So there's all kinds of ways that they can manipulate this treasury balance sheet, this sovereign wealth fund balance sheet, to essentially bring in assets. And then what they can do is they can start monetizing that in a way that in the past only the Federal Reserve has been able to do. It's always the Federal Reserve balance sheet. Like people talk about, oh, well, they increased the Federal Reserve balance sheet. And so what they're going to do is they're going to be like, okay, we're going to take the sovereign wealth fund and we're going to use this collateral to buy 10-year treasuries, or we're going to issue the quote unquote Mar-a-Lago Accords that have been talked about. We're going to issue a 50-year treasury bond with zero coupon backed by gold, which would be held in this sovereign wealth fund. So I think there's going to be ways that they are literally going to strip away power from the Federal Reserve. And they're not doing it yet because they know they cannot control Powell. And I don't think they want a public fight with Powell because they know they can replace him, a year from now, and he'll be gone. And they'll have somebody in there that's going to play ball. So this plays into, for example, the gold revaluation. So the U.S. gold on the Treasury's balance sheet is valued at $42.22 an ounce. This is based on Nixon in 73 revalued it to that level according to different laws. And I actually went in and I researched all these laws. It's like the Gold Reserve Act of 1934. There was another big thing that allowed the president to revalue gold, part of the AAA, the Agricultural Adjustment Act of 1933. There's a specific clause in there known as the Thomas Amendment. At the time, it was called the Inflation Amendment because it was the legal mechanism that allowed Roosevelt to revalue gold from $20 to $35 an ounce. So there are all of these legal, and the Trump administration loves to do it. They've just been using the Alien Enemies Act of 1793. Like, they love pulling this stuff out of the woodwork. And I think they're going to be pulling out the Agricultural Adjustment Act of 1933 and the Gold Reserve Act of 1934, and they're going to be revaluing gold to $3,000 an ounce. They're going to get an $800 billion injection from the Federal Reserve, debt-free, interest-free. That's essentially QE. That's massive QE. That's money printing. And so they're going to take over the monetary policy. And, there are, hiccups in that. So a lot of people really quick is just so people know is they've talked about this, but I don't know if they've actually researched the legal precedents of it. So that Thomas Amendment in the Agricultural Adjustment Act that allows the president to revalue gold, it limits him of revaluing it at 50% of the value, which would mean at $42, he could only revalue it up to like 60. But it doesn't necessarily say like how many times he can do it or whatever. So I think there's going to be ways that they can do it, but it's not so simple as just, okay, one day Trump's going to announce gold's 3,000. I don't think he has the authority to do that given the laws, but I do think that there's going to be a path to do this. And this is the retaking control of money from the bankers and bringing it back to the people. This is the same thing that Andrew Jackson did when he got rid of the Second Central Bank of the United States. I think that the era of central banking dominance is coming to an end.
That's a good thing, I think.
A great thing. But a great thing.
Going back to your explanation, am I understanding it correctly? Specifically, the sovereign wealth fund sort of returning the U.S., maybe not to a pure gold-backed currency system, but the sovereign wealth fund itself will be built up of neutral assets and cash flows that the incoming monetary system will be based off of, at least here in the U.S. internally.
Yeah. Well, so still very bullish on gold and Bitcoin because I think one inflationary system is going to be replaced by another inflationary system. So we're still going to maintain a fiat system, but the control is no longer going to be in an independent central bank that is essentially beholden to the Citibanks and JP Morgans of the world. So, if you look at, who owns the Federal Reserve branches, if you go, okay, not the FOMC, which is the Open Market Committee, but if you look at the Federal Reserve Bank of New York or the Federal Reserve Bank of Chicago, and you say, who owns those banks? Those are corporations that are owned by JP Morgan, Citigroup, Morgan Stanley. This is public knowledge. The Federal Reserve, in fact, I think it was in 2017, someone had sent a FOIA request to the Federal Reserve Bank of New York and said, who are your shareholders? What's the cap table? And surprisingly, they actually answered the letter. And they said, number one, we are not a government agency and we're not under FOIA and we're under no obligation to release this information. But in the interest of transparency, we're going to tell you. And the top two shareholders were JP Morgan and Citibank. That's who owns the Federal Reserve of New York. So what's happening is that these large banking institutions, which have essentially milked the American people for over 100 years, since 1913, and the founding of the Federal Reserve, the same year that the income tax came in, they are now being pushed to the side as secondary institutions. Now, I'm not saying that means their stocks are going to go to zero and JP Morgan and Morgan Stanley aren't going to make money. They're going to make money. But I think that the days of someone like a Powell being unilaterally in charge of U.S. monetary policy are going to be over, and it's going to be brought more into the Treasury. And this is this whole set of concerns with that, because once the Treasury gets a hold of it, you get the political bias to print money and do this. And so that becomes very inflationary. And I still think at the end of the day, we're heading for a massive inflationary spike. That once we get through this, tumult that we're going through right now, some of the companies, if you look at the stock market, that are going to, in my opinion, do the best coming out of this are going to be things like industrials, materials, commodity companies, not necessarily oil, because I think energy is being purposefully kept down. So I'm not bullish on something like the XLE or the energy sector ETF, but something like a FCX, like a Freeport-McMoRan, which is a copper and gold producer. Like, I think these are going to be like companies that might do better on a percentage basis than an NVIDIA or an Apple, starting in, say, June and this year until June or December of 2026, because these commodities are now becoming the basis of the monetary system, which is what they should be. The basis of the monetary system should not be a fiat currency that can be printed at whim. It should be commodities, and it should be oil, it should be gas. And then if you want a neutral asset that can act as an arbiter between all of these countries as they try to manipulate their currencies and play trade wars, you want a neutral asset. Historically, that neutral asset has been gold, but Bitcoin can also serve as that neutral asset as well. And I think when we talked last time, I talked about a world where both Bitcoin and gold begin serving this neutral monetary asset thing. You talked about maybe it could, why doesn't it go to just one or the other? And I tended to think that there are certain reasons why certain foreign central banks prefer gold. They feel maybe Bitcoin is a little US dominated, different things, and that's why gold would be a big part of it. But that I also felt Bitcoin will be a big part of it, as well as the digital assets economy. Tokenization is going to explode. You've got Saks, the crypto czar, like as assets, as securities, as everything starts getting traded on the blockchain and people say, wow, digital assets are, the future, then they're going to say, what's the ultimate digital asset store of value? That's going to be Bitcoin. Bitcoin's going to become part of institutional portfolios. It already is. And so it's very bullish for Bitcoin and gold. And I think there's room for both. And that's, my opinion. I know some people have different opinions, but my opinion is that both Bitcoin and gold can serve as neutral monetary assets.
It seems to be playing out too. You just look at how much gold Russia and China have accumulated over the course of this century. It makes sense that you would want a natural reserve asset hedge against Bitcoin in case it does become U.S. dominant. But I do think Russia and China certainly have good exposure. Definitely not public about it, but I would be shocked if they didn't have massive exposure to Bitcoin as well. And you mentioned something in passing about the introduction of the income tax around 1913 too. Obviously that has been a big meme for Trump, this shift from internal revenue service to external revenue service. Do you think and obviously last week Lutnick was on the media trail basically saying we're going to eliminate income taxes for individuals making less than $150,000 a year. Do you think there is real momentum behind this idea of eliminating income taxes in the United States, and this threshold of $150,000 is simply a first step in that direction?
Yeah, I really do. I think they can do it. I don't think there's any reason why they can't do it. And I think that it will be a net positive. And here's why. There are a lot of people in this country who don't work because of income taxes. So, if you go and you get a job and you make $50,000, $60,000 a year, and the government takes $20,000 of that, and you're left with $40,000, and if you went on benefits, you could collect more or less, let's call it $25,000 or $30,000, and you say, I just worked the whole year for $10,000. then you've got a bunch of people that are not stupid, and they're doing that mental calculus, and they're saying, if I can just get myself down to living on SNAP benefits and living in Section 8 housing and not paying any taxes, and because of inflation, that level is much higher than most people would think. Like, a lot of people might think, oh, as long as you're making 30 grand, you're better off working. No. Given the safety net, you need to make $60,000, $70,000 a year before it makes any sense for you to take a job. Otherwise, you're probably, and not only that, but because of the gig economy, because they can say, okay, you know what? I'm going to make nothing, but my wife, I'm going to, use your driver's license, or I'm going to use my brother-in-law's driver's license, and I'm going to go drive Uber. And, like, there are so many ways to rig the system so that it doesn't make sense for you to work and pay in at under 100 grand. Like, it totally makes sense to cut out taxes under 100 grand. Maybe 150 is a little high right now, but in the coming years, it'll eventually get there. So I think what it is it's like, we need to motivate people to take full-time jobs. And we need that because we're going to need to fill full-time jobs. I had some data here I had run the other day. This was, I had gone back to the December 2019 BLS payroll report to look at, jobs broken down between foreign-born and native-born, which is how the BLS breaks it down, and compare it to from December 2019, which was the last month before COVID really hit under Trump, and then December 2024 under Biden. And I looked, and it was native-born 2019, 131,281,000 jobs. In 2024, so 5 years later, native-born jobs were 130,565,000 for a net loss of 716,000 jobs. So between 2019 and 2024, the number of native-born Americans holding a job in this country went down by 716,000. If you look at foreign-born, in December of 2019, that number is 27,223. And then you go to 2024, it's 30,729,000 for an increase of 3,509,000. So between 2019 and 2024, we created over 3.5 million jobs for foreign-born individuals, and we lost 716,000 jobs for native-born individuals. And that is BLS numbers. That's not me. I mean, these numbers are probably even light. So in other words, we created millions upon millions of jobs for foreign-born people under the Biden administration, and we lost 716,000 jobs for Americans. And the last thing I'll add is the increase in unemployment, because this is key. At the end of Trump, there were only 863,000 foreign-born people in the country on unemployment. By the end of Biden, it was over 4.5 million. And so
holy shit.
We created all of these jobs for foreign-born, but we skyrocketed the unemployment payrolls for foreign-born, and American-borns didn't get anything. Now, there was a slight decrease in the native-born working age population, a slight decrease, like 300,000. So because of baby boomers retiring, the baseline didn't increase. But I mean, it's ridiculous. It's ridiculous. And this is what we did. And last thing I'll add, this is the monthly Treasury statement, which the Treasury Department puts out. Nice picture of Alexander Hamilton on there. I mean, in February, this came out a couple of days ago, we ran a deficit in February of $307 billion, and we had total tax receipts of $296 billion. Meaning we spent over $600 billion last month, and we only took in 296, and we're at $1,147 billion deficit so far this fiscal year, which is a 40% increase from last year. So these things just cannot continue. We cannot keep printing money ad infinitum, running up deficits, providing jobs for foreign-born individuals as they explode our unemployment. I mean, that's what's been going on. So he's trying to stop this, and that's obviously going to cause some dislocations in equity markets, which have been used to, I've seen figures as high as 150,000 per illegal immigrant as far as stimulus to the economy. When you factor in all the government support over a 12-month period, this is what we have to deal with. I mean, it's reality.
Yeah, I would love to overlay the foreign-born additional jobs with remittance numbers as well, because that's another thing that you have to factor. A lot of these people are taking jobs away from native United States citizens. You would hope that they're at least spending the money within the country, but I would not be surprised if remittance numbers went up commensurately with that growth as well, which would signal that they're making money here and sending it abroad.
Yeah, which they absolutely are. They absolutely are. And Bessent said this on, I think it was Face the Nation or another interview. He said, we're going to see real wage increases for American workers. And I think the use of real wage increases is key, because that doesn't necessarily mean we're going back to 2% inflation anytime soon. It just means that wages are going to increase more. And had under the Biden administration, the border been closed, even though I think we would have suffered inflation because of what we did during COVID, I think real wages would have kept up with it. But because of this, because of flooding the market with millions and millions of foreign-born workers, wages did not keep up with inflation. And so that's really the big problem. I mean, if you look at it, at the end of the day, if you're 35 years old, you got 2 kids, you're $40,000 in credit card debt, you owe $10,000, $20,000 on a car, and you've got a job, the best thing that can happen to you is high inflation, but your wages go up even more, because that high inflation is going to bring down the real value of your car debt, of your credit card debt. The worst thing that can happen to you is low inflation with wages that don't even meet that, because then the real value of your debt stays the same and your real wages don't go up. So if Trump wants to really help out his base, and I think this messaging isn't there yet, but eventually it's going to come, we're going to have 3 to 5% inflation, but wages are going to go up 4 to 6 or 7%. And so you're going to have real wage increases, inflation. This is going to inflate the stock market. It's going to inflate Bitcoin. It's going to inflate gold. And it's going to, my ridiculous prediction was like end of the Trump administration, we're at S&P 15,000. Because I think we need to inflate our way out of this mess. And that's also not only going to help Trump's base, who's in debt, but it's going to help the United States government, which is obviously $36 trillion in debt. So we need to inflate away the dollar, kill the bondholders, and that is just uber bullish for Bitcoin and gold.
Yeah. So in terms of capital deployment, at the end of last year, you said you were heavy in the cash and you predicted that we'd have this tumult to start the Trump administration. After a period of time, we'd begin to recover, as you're saying today, later this summer or fall. So with that in mind, how's your allocation strategy been? Are you buying as the market falls? Are you holding, waiting for a dropout to come in size, or what? How are you approaching this?
Well, I'm looking for certain signals. I think we've seen signals in the very short term that we could be due for a nice bounce. So we're recording this on St. Patty's Day. This week we have the Federal Reserve meeting on Wednesday. We have VIX options expiration. We have quarterly options expiration coming up next week at the end of the first quarter. So I think there's some volatility to be had heading into this April 2nd event, and that could present sometime between now and say April 2nd, could present a period where it's time for me to start deploying some of that cash. I haven't yet. So I've still held on to it. I've still thought there's further to the downside, but I don't want to get too cute about it, because then the market can get away. So I've been saying to myself, if we see the S&P hit 15% down, I need to put like a third of that money to work. If we go down to 20%, I'll still have another third. If we go down even further, I'll have another third. If 15% is the low, then I probably need to start putting some money in at 10% because I don't want to wait for it to go up. But I need to see what's happening as these things occur. So for me, I'm very careful around this April 2nd timeline, and it happens to coincide with the end of the quarter. And the other thing about the end of the quarter is we saw at the end of 2024, last week of December, we saw a big sell-off. And this has to do with like repos, and there are weird things that happen. So like European banks have different rules than American banks. So certain European banks need to have certain amounts of liquidity only at the end of a quarter. Like they get looked at by their regulator. What are your balances at, March 31st? And so you see liquidity a lot of times recently getting drained from the system around end of quarters. And that happens to coincide with this April 2nd. So, this is a short-term call, and those can always be wrong, so take it with a grain of salt. But I'm thinking we're probably looking for like a 5,500 to 5,000, somewhere below 5,500 in the S&P around the first week of April, last week of March. That will be a point where it's like, even if it, stinks from hell to high water, I just have to hold my nose and put some money in, because now it's going to be down like 15% and it just is going to make sense to do it. I think with Bitcoin, I've been, like I said, keeping an eye on that. My read on that was 83,774 as a monthly close. When it gets below that, I think it's a good point to go into it. I've been playing it short term because I think we still have to get through this transition period before we get a longer term holding period. So I'm not like deploying huge amounts into it yet. Gold, that I think we had a breakout last week. So I've been heavy into gold. On my work, we had a Fibonacci level at $2,968 on the futures contract. We broke above it last week. I think we're heading to 3,100 on gold in the next week or two. Could definitely push up beyond that. So I think that all these things are starting to come into place. It's going to be getting very interesting. But I think with the tariffs, the Fed meeting, the options expiration, the VIX expiration, all coming up, the quarter end, and all the wonky stuff that happens around quarter end, that we're getting close to a point to start putting money to work. And that doesn't mean we can't still go down a little bit more in April, but like this is not like I said, don't try to get too cute. Like so far so good. You sold when it was 6,100. Like get some back in if it goes down to 5,000, and then if you're wrong, and it goes down further, put some more in. So that's where I'm at. I'm looking, and I have a feeling like we're getting ready for a first deployment of this cash haul in the next week or two.
Awesome. Yeah, it'll be interesting to see. Historically, Bitcoin has sort of been the leading indicator alarm bell, where it dumps first and then recovers first as well before markets ultimately tank. It'll be interesting to see if that move to the mid 70s last week or a couple weeks ago was that, or if it's just a tremor before a bigger drop down.
Yeah, well, I mean, they want to do it. I mean, they had Bessent on and Tax on Fox this weekend. I think they've got a game plan. Cynthia Loomis put it out in a podcast about a month ago. She said, number one, they're going to try to get the Genius Act passed, which is the stablecoin bill. Then they're going to try to get regulatory clarity on digital assets, who's under SEC, who's under CFTC, commodity versus security type questions. And then they're going to talk about exactly what's happening with the Bitcoin strategic reserve. And I think that lines up nicely with Bessent talking about with Ludnick that they're going to get the sovereign wealth fund stood up within 12 months. And that was like back in January. So around the end of the year. So I think we've got a game plan. A, wait for the stablecoin bill to be passed. B, wait for some regulatory clarity. If that happens sometime in the summer, like, we're setting the stage for then C, which is sovereign wealth fund, which is going to be Bitcoin. And I think, frankly, I'm not even really that concerned about the sovereign wealth fund. There were a lot of people in 1971 when the U.S. went off the gold, said, you know what, gold's going to plummet, and it skyrocketed. So I think Bitcoin stands on its own merits. I don't think it needs a sovereign wealth fund to be, what it is. I think that if it happens, it could be a short-term catalyst. But I think at the end of the day, what Bitcoin is, as everybody gets more comfortable, the world is getting more comfortable with digital assets. They're getting comfortable with tokenization. Once securities get tokenized, the dollar gets tokenized, stable coins get legitimate regulatory backing. Once all of this stuff starts to happen, people will start to see digital assets as real money. And then they'll start to say, well, what is the gold of digital assets? And obviously that's Bitcoin. And people will begin to say, okay, this is digital gold. This is what it's purported to be by Satoshi. This is why it's called mining. This is why, it was created, a peer-to-peer cashless payment system, yes, but also a store of value. And so I think all of that's going to happen. And I think the peer-to-peer cashless is coming too. I think with Nostr and different, elements that are being put into place to be layered onto Lightning so that we can get to a place where people don't need Visa or MasterCard or the US government or anybody. And once people realize the power of that, then the potential is exponential. And I've always told people, I don't know what's going to do better over the next 12 months on a percentage basis, gold or Bitcoin. I feel pretty dang confident Bitcoin's going to do a lot better than gold on a percentage basis over the next 5 or 10 years. So that's where I'm at with gold, Bitcoin, stocks, everything. I'm very bullish, but I'm just not ready to pull the trigger at this point in time, but I'm getting close.
It's great to know. And should we just do this quarterly now? Maybe we meet up at the middle of Q2 to see where things are.
That would be perfect. I would love to do it and see if we're hitting, we're tracking. I appreciate coming on and love these conversations. So thank you, Marty.
Thank you, Mel. It's always fun with you because I think you, out of everybody that I speak with in terms of macro and markets on this show, you have the most unique perspective. And that's one thing we're trying to do here. Moving forward, we actually have an idea for an app that we want to spin out is tracking predictions that are made on the show and letting people know who's actually been right. And so far, the first 2 episodes, I think your calls have been spot on. So thank you.
Yeah, I think the first one I came on, I said S&P 6,000 by end of the year. Next one I came on, I said we're ready for a dump in the first half. And I'm not trying to blow my whistle, but you know what? It's funny because I do have, people want to follow me, Mel Mattison 1 on Twitter. I only have like 2,000 or 3,000 followers. And like people are like, Mel, I don't understand. Why don't people follow you on Twitter? Like you have some of the best stuff. Like you're amazing. And it's like, honestly, I don't really try. Like I'm out here doing my own thing. I love investing. I had a 20 plus year career, startups, financial services, Duke MBA, made my money, quote unquote, and I do my thing and I just put it out there. So I don't always do the slickest things. I don't have really nice, like 10 post threads and stuff, but like there are nuggets in there. So if you want to get some of these nuggets when they come across, follow me at Mel Mattison 1 or check out my website, melmattison.com, or I wrote a book too called Quaz. It's kind of a financial thriller about corrupt central banks that people might find interesting. Has to do with the blockchain as well. So, I mean, that's what I do. And I love just coming out here and talking about this stuff. And if I ever really got serious about trying to market myself, maybe I could do well, but it's just not what I do. I just love coming out, talking, sharing my views and having these types of conversations.
Well, thank you for doing it. And thank you for coming on this show. And we'll link to all that in the show notes. Mel, go enjoy your St. Paddy's Day.
You too, Marty. Thank you.
All right. Peace and love, freaks. Bitkey.